Welcome back to Investing Talk Podcast.
Good to be here.
So we're tackling a question that honestly keeps popping up. Is HIMS and Hers Health a good buy right now?
Yeah, it's definitely got a lot of attention. That stock momentum has been pretty wild.
Exactly. So we've gathered up the latest Q2 filings, looked at the technical charts, market talk, everything we could find to see if this digital health company still has room to run. Before we really get into the weeds, though, just a quick reminder. If you find these discussions valuable, please do hit that subscribe button.
Give us a like, too.
Yeah, and leave a comment below. Seriously, if there's a company you want us to look into, just let us know in the comments.
We do read them.
We do. So our goal today is basically take all this data and boil it down into something useful for, your own investing journey.
Let's do it.
Okay, let's kick off with the fundamentals. I mean, that's usually the starting point, right?
Absolutely.
For HIMS and Hers Health, the big story seems to be just, explosive growth.
Yeah.
Looking at that Q2 2025 report, what were the numbers that really stood out?
Well, explosive is definitely the right word, particularly the revenue acceleration. Q2 revenue came in at $544.83 million.
Okay.
But the key thing is the context, right? That's a massive 65% jump year over year. Huge growth from the $329 million or so they did the year before.
65%?
Wow. And it doesn't look like it's slowing down. Their guidance for Q3, they're targeting almost $580 million. So $579.34 million, I think it was. They seem to be accelerating into the second half of the year.
That is some serious top-line momentum, no doubt. But, growth, just for growth's sake, can sometimes hide issues underneath.
True.
You see these companies with huge revenue, but massive cost burning cash. Can we trust this growth? Is it actually translating into profit?
Yeah, that's always the crucial question, isn't it? And in this case, HIMS and Hers seems to be delivering. The profitability numbers suggest they've really improved their scalability and operational leverage.
Right.
We're actually seeing real net income now. If you look at the last 12 months, their net income is sitting at about $126 million.
$126 million profit.
Yeah, which gives them a pretty solid net margin, around 8.5%.
That's actually, quite impressive for a company scaling this fast in that sort of tech health space.
It is.
Did they beat what the analysts were expecting?
No, absolutely. The earnings beat really highlights, I think, management's control. Q2 EPS was $0.17.
Okay.
And that was almost a 13% beat versus the consensus.
Right.
When a company consistently beats high expectations like that, it suggests they have a pretty good handle on their costs and revenue. They're not just lowballing guidance.
Makes sense. And what are they guiding for next quarter?
Still looks pretty bullish. Guidance is around 0.10 cents per share for Q3.
Okay, so incredibly healthy on the growth and profit front, it seems. But often, these high growth stories, they need constant cash injections. Dilution risk. How stable is the foundation? The balance sheet behind all this momentum.
That's actually one of the really strong points here. The balance sheet gives them a lot of flexibility.
Okay.
They've got over $500 million in cash and equivalents.
Wow.
And minimal debt. We're talking less than $100 million in total liabilities. And crucially, they're free cash flow positive.
Oh, that's key.
Yeah. It means they're basically funding their own growth internally now. That supports reinvestment, gives them a buffer, shields them a bit from market volatility, unlike some competitors maybe drowning in debt.
That financial strength is definitely reassuring. But let's talk efficiency, because that's where this digital model should really shine, right?
Exactly.
You highlighted something about their revenue per employee.
Yeah, and this is fascinating. It really shows the power of their model. Their revenue per employee, looking at the trailing 12 months, TTM, it's an incredible $902,000.
$100,000 per employee.
Per employee.
Yeah.
That just blows away a lot of peers, even other online healthcare players. It screams exceptional cost efficiency.
So they're really leveraging the tech.
Totally. AI interfaces, automated prescriptions, standardized processes. It lets them scale fast without needing a proportional increase in staff.
It's almost like they built this digital machine.
Pretty much. They built the infrastructure, and now they're optimizing it. But, efficiency isn't everything. We need to understand their competitive advantage.
Right. What stops competitors, big pharma or even other startups?
$1 million question, or maybe $1 billion in this case.
Yeah. So what gives them the edge? Is it just being cheap, or is there a real barrier that justifies this kind of valuation?
Well, it seems to be a mix. They definitely have that first mover advantage, especially in building the brand for personalized wellness.
Hmm.
They sort of destigmatized and streamlined care for things like hair loss, ED, anxiety, made it accessible.
Okay.
But the key to their future moat, I think, isn't just those common conditions, it's their move into more specialized care.
Specialty here, how do you mean?
Well, look at their recent launch into men's health. Specifically, they're featuring a branded oral testosterone therapy, KYZHX,
Oh, okay.
and they're looking at broader hormone health management too. This is a really strategic pivot.
How so?
They're moving from just facilitating simple generic prescriptions to actually providing specialty treatments. These require more complex oversight, and importantly, they often come with higher pricing power.
So it's a deliberate shift
Hmm.
from general telehealth towards something more like a specialty pharma setup, but digital.
Exactly. And that raises the barrier to entry quite a bit.
Oh.
Well, something like oral testosterone, KYZHX, it targets a big market that was maybe underserved, and
Yeah.
it's an innovative needle-free option. But more than that, it needs more complex supply chains, specialized medical protocols.
Yeah.
So any competitor doesn't just need to copy their website, they need to build out all that back-end infrastructure and the relationships for these higher stakes treatments. That's way harder and more expensive.
Okay, that sounds like a solid long-term strategy. But what about the short term? What catalysts should investors be watching over, say, the next 6 months?
Yeah, the next 3 or 4 months look pretty critical. Number one is definitely the Q3 earnings report that's expected around November 4th.
Okay.
Given their track record, if they deliver another beat on revenue and EPS, that could easily fuel the next leg up, especially if they show those margins are holding up or improving.
Right, the margin pressure point we'll get to. What else?
Beyond earnings, look for new product rollouts. They flagged new wellness and prescription offerings for Q4. That should help diversify revenue.
Makes sense. And what about, the rumors, the market noise? Sometimes that drives the price as much as the facts.
Yeah, the noise right now is pretty focused on weight loss.
Ah, the GLP-1.
Exactly. There's persistent chatter about them potentially offering generic semaglutide or similar GLP-1 drugs.
That'd be huge.
Colossal market potential. If they can figure out the distribution and scaling for that, leveraging their existing customer base, I mean, it could be a massive new segment for them.
Wow. Anything else in the rumor mill?
Well, there's always talk about potential M&A, maybe smaller strategic acquisitions, and also AI breakthroughs, given that efficiency metric we talked about.
The $900 per employee.
Right. If they can use AI to streamline things even further, maybe patient interactions or fulfillment, that number could potentially go even higher.
That brings up a potential issue, though. You're talking about aggressive scaling complex new areas like hormone therapy, maybe GLP-1s.
Yeah,
That puts huge stress on operations.
absolutely. It's a real risk.
Has management shown they recognize that need for operational excellence during all this growth?
They seem to have. Appointing Mike Chi as COO back in November 2025, that looks like a clear signal.
Okay.
It reinforces that focus on operations exactly when they need it most during this really rapid scaling phase. It suggests they know they need flawless execution now, not just growth at all costs.
All right, this is where it gets really interesting for me. Moving from the fundamentals, which, sound pretty great,
Yeah, mostly strong.
to the technicals.
Yeah.
The chart, the actual price action right now, early October 2025. Does the chart back up this bullish story, or is the stock maybe looking a bit overextended?
Well, the chart actually confirms that sustained bullish momentum, even with some recent choppiness. The stock's trading around, $52.54 as of October 6th.
Okay.
And crucially, it's holding above two really important technical lines, the 50-day simple moving average, the SMA, and the big one, the 200-day SMA.
Okay, maybe just quickly for listeners newer to charts, why are those moving averages so significant?
Sure. So the 200-day SMA, that's currently down around $43.89. Think of that as the ultimate long-term trend indicator. Trading above it generally means the big picture is bullish.
Got it.
The 50-day SMA, that's shorter term, currently $51.77. It shows the near-term momentum is also strong. So being above both is a classic technical sign that the uptrend is still very much intact.
Okay, solid technical footing then. What about specific price levels to watch? Support, resistance.
Yeah, looking at the chart, near-term support seems pretty firm in that $50 to $51 zone. If it bounces from there and breaks higher, the next key resistance level looks like $56. A break above that could see it move towards $60 fairly quickly.
And momentum. Is it like wildly overbought right now?
Actually, no. The RSI, the 14-day relative strength index, is sitting around 59.4,
Which means?
which is sort of neutral to bullish. It basically means there's still room for the stock to run higher before it hits that really overbought territory that often signals a pullback might be coming.
Okay, so the chart seems to broadly agree with the fundamental story.
Uh-huh.
But, investing is never risk-free.
Never.
What are the big warnings? What should someone thinking about this stock really be cautious about, especially with this high growth and, well, the volatility in the digital health sector?
Right. There are three main risks to keep a very close eye on. First, as you mentioned, volatility. The stock has a really high one-year beta, 2.58.
2.58. What does that actually mean for an investor? If the market goes down 1%, what happens?
It means this stock is expected mathematically to be almost 2.6 times as volatile as the overall market. So yeah, if the S&P 500 drops 1%, HIMS and HERS might drop around 2.6%. And the same applies on the way up.
So big swing.
Big swings.
Yeah.
It definitely requires strong risk management. You need to be prepared for amplified moves, both up and down.
Okay, risk one, volatility. What's next?
Second risk is margin pressure. While the revenue growth is amazing, the Q2 report did mention a contraction in gross margin.
Okay. Why?
They put it down to higher product costs. Management really needs to get a handle on controlling those rising costs if they want to sustain profitability, especially as they move into these more complex, maybe lower margin initially specialty areas we talked about.
Now, I want to connect those last 2 points. You mentioned margin contraction in Q2. And we know they're pushing hard into new complex areas like hormone therapy, maybe GLP-1s. Was that Q2 margin dip maybe a warning sign? Are they already feeling the strain of launching these complex things too fast? Is expansion hurting the core profitability?
That's the absolute crucial connection to make. And it leads directly to the third risk, execution risk.
Right.
Competition from traditional players or other digital startups is a threat, sure. But arguably, the biggest risk is internal right now. Meaning just the inherent difficulty of rapidly launching and scaling complex new services. Think about digital behavioral health or the logistics of handling generic semaglutides safely and efficiently.
Yeah, that's not simple stuff.
Not at all. It carries huge execution risk. If the costs to acquire customers for these new services or the costs to fulfill them keep rising faster than expected, then that amazing $902,000 revenue per employee number, that could come under serious pressure very quickly.
Okay, so let's try and wrap this up. Bring it all together for someone listening. What does it all mean? We've got this picture of exceptional growth, both revenue and EPS.
Very strong.
A really solid balance sheet, good efficiency metrics.
Yeah, that $900 K number.
Clear technical support on the chart, and these major product initiatives like the push into men's hormone health.
Right. So putting it all together, the analysis points towards an overall bullish rating. I'd give it about an 8.5 out of 10.
Okay, 8.5. Pretty strong.
Yeah. I mean, despite the high volatility and that recent margin concern, the sheer scale of the growth, backed by strong cash flow and smart strategic expansion, it warrants a very positive view, I think.
So good for traders and long-term investors.
It seems attractive for both, actually. Short-term traders might play the potential Q3 earnings beat. Long-term investors are buying into that structural growth story in digital health. The fundamentals provide a high floor, and that specialty expansion offers potentially massive upside.
That's a compelling case. So I guess given everything we've discussed, management's confidence, the aggressive expansion plans, the key question isn't really if they can keep growing revenue. They clearly can.
Right.
The real question seems to be whether they can maintain that incredible efficiency, that nearly $1 million per employee engine, while they absorb these potentially huge but complex new products like semaglutide. Can they balance that speed with the necessary discipline?
That's precisely it. Operational discipline meeting aggressive growth. That is the tightrope they have to walk over the next year or so.
Yeah.
That balance will likely define where the stock goes from here.
A tightrope walk indeed. Well, thank you for joining us for this analysis today.
My pleasure.
We really hope breaking this down helps you on your own investing journey. We'll be back soon with another look at a company making waves.